Good morning. This is Barry Knapp with Ironsides Macroeconomics. It's Tuesday morning, January 21st at 7:40 a.m. Arizona time. Never changes out here, apparently. Our note this week was titled Turning the Page. It's an obvious reference to having passed Inauguration Day and meet the new boss, same as the boss back in 16 to 20. Sort of the old boss, right? The first section of the note was, about that event, the impacts on the markets. We then moved on to discuss our review inflation week last week. We titled that section Inflation Convergence. We then discussed the labor market a bit further, having discussed it in the prior week's note following the monthly payroll report. But this week in particular, we received the Atlanta Fed wage tracker data that we thought was important and titled that section, The Labor Market is Not a Source of Inflation Risk, even with potentially reduced immigration. We then discussed consumption on the back of the retail sales report and discussed some of the tailwinds, one secular and a couple of cyclical tailwinds. Had a section on financial sector deregulation prompted by bank earnings last week, and then wrapped it up with a section we titled No Data, No Opinion, which was a reference to something that incoming Treasury Secretary Bessent said in his hearings last week. So we would describe what happened last week in the Treasury market in particular as the Bessent rally more so than the inflation rally. Inflation didn't really drive rates up over the course of the last couple of months. Sure, break-evens widened a little bit, but it was primarily about real rates going up, term premium, and concerns about debt and deficits. We did have a ferocious rally in equities and treasuries on inflation day, and it did mitigate some risk of the Fed overreacting to some disappointment around the inflation data, core measures flattening out a little bit late in the year. But we thought that was completely misplaced and not really what markets were concerned about. It was as an excuse as much as anything. A lot more of the rally we would again attribute to the Bessent hearings having gone well. If you recall, the week that he was appointed by Trump, we had a 20 basis point across the curve rally in treasuries, right? Rates came down 20 basis points from twos all the way up to 30s. It was very similar last week. And of course, with that rally, the equity market broadened out to include energy, materials, and financials, all of which should benefit from policy and a stabilization of debt, which if we can get there. Now that's far from a foregone conclusion. So moving on to the inflation situation, we still think we're at some form of long-term price stability. The inflation rate at 2.9% is right near its average since that series really was reported monthly back in 1947. We are getting this convergence between goods inflation, which goods deflation is dissipating to some extent. Goods prices are coming up, but services prices are coming down, primarily driven by the housing input. We think that will continue to put downward pressure on core inflation through the first half of the year, notwithstanding the screwy seasonality in January. Goods prices we do not expect to persist, meaning we think they'll probably turn back lower because of deflation and the massive excess capacity out of China, and the fact that trade-weighted dollars had an 8% move higher, notwithstanding its little rally today on the basis of Trump not starting out with executive orders on tariffs. Still, though, those measures are starting to converge, and we do think there'll be some downward pressure. We do not see it the way the Fed sees it, where there's real upside risk to inflation. As far as the labor market goes, as I mentioned, this wage tracker from the Atlanta Fed was a really key measure last week. The chart I've got in the background of this video, and we published in the report, is truly crucial. It shows just all the pressure on the lowest income quartiles. This is true of workers that are paid hourly. This is true of the lowest quartile. And it's hard to see how even a slowdown in immigration is going to totally reverse this and drive those wages substantially higher. We never had a wage price spiral during the pandemic. Wages followed prices, not vice versa. And right now, that lower income quartile is under such pressure that it's hard to imagine that even a slowdown in immigration is going to really turn that chart around, make some sort of a V bottom and drive wages up. So we think that that's just the wrong way to think about the labor market. As usual, demand-based neo-Keynesian or New Keynesian economists are getting this wrong. Moving on to consumer spending, retail sales are running slightly above trend, not way above trend, but they're at a pretty healthy rate. And we described some tailwinds. First one is the secular tailwind that we continue to think is underappreciated. It's something we've written about in our thematic notes. Not this year, we didn't discuss it, but the year before we did. And it really has to do with lifestyle consumption patterns and the idea that for almost 20 years, from the late 90s through 2014, one of the biggest age cohorts, the boomers, were in peak retirement mode. So they weren't consuming at the same level that they had been. And the cohort that was at peak consumption level, that would be Gen Xers, is actually the smallest age cohort. And so that put downward pressure on consumption. Well, now we're at the biggest age cohort, millennials, in peak consumption mode. And the boomers, having moved into retirement, are now spending on the margin more than they were when they were at peak savings mode. And the savings cohort is the Gen Xers, the smallest cohort. So that's in aggregate putting upward pressure on consumption. So there's your tailwind. We've guesstimated that to be worth about 50 basis points or so in trend consumption. Now, the cyclical tailwinds are of more concern. Those are government direct transfers as a percent of disposable income, 130 basis points above where they were when President Biden was elected, and that may change. Those are some of the considerations put forth by the tax writing committee in the House that is talking about cutting or putting work requirements on food stamps and welfare that were reversed by Obama and then Biden later. So that could put some downward pressure on consumption. And of course, the wealth effects created by the Fed's holdings of large-scale asset purchases, holdings of long-term bonds, and the very passive approach that Treasury's taken to issuance and the Fed has taken to unwind that portfolio, that could put somewhat downward pressure on that wealth effect, but probably not a considerable one. There's other obvious offsets like deregulation and potentially stronger corporate earnings, stability from capital investment, or stronger corporate earnings as a consequence of capital investment. But anyway, those are the things that we think are the big picture issues for consumer spending on a go-forward basis. Moving on to the financial sector, ROE has moved up fairly sharply this quarter with the banks we've seen thus far. Some of that's capital markets activity for the big banks, and some of that is a disinversion of the yield curve for smaller banks. Deposits then tend to be sticky when rates are going up, but not so sticky when rates are going down. So that 25-month disinversion of the 3-month 10-year curve, the longest we ever had, will have a real impact on earnings on a go-forward basis. But the big issue here is really going to be capital release. We always thought the Basel framework was foolish. Why we would want to emulate Europe, I'll never know. And I heard numbers tossed around last week in the neighborhood of $180 billion that could be returned to shareholders or invested in loans and the like. M&A activity will really help the smaller banks who need scale to be able to compete from a technology perspective. And of course, M&A will help bigger banks from a broad business perspective, capital markets activity, all those sorts of things. We would differentiate between the higher for longer big banks and the more traditional banks. We think there's more upside to the more traditional, lending out deposit type banks, but nonetheless, the outlook for the banking sector is quite favorable. I realize valuations look a little bit more elevated, but if you return a lot of capital, that'll change pretty quickly. And then the final section we wrote was titled "No Data, No Opinion," a quote we absolutely loved from incoming Treasury Secretary Bessent. It's long been our philosophy, trying not to have an opinion about something that we can't really form some type of quantitative support for. They still have a daunting debt problem. We need to extend the duration of issuance. That's going to put upward pressure on rates. The Fed may continue QT all the way to the third quarter now. Our former colleague Joe Abate is one of the best money market strategists out there. Was calculating, his threshold, and it's it's a very inexact science based upon the amount of reserves as a percent of bank assets, and he thinks there's room likely to continue QT through the third quarter. We talked about the movement in the RRP program and bank reserves. We had a drop in bank reserves right before the end of the year. It's rebounded. They're back at $3.25 trillion. And so it looks like QT can continue longer. And we hope it does continue longer than the original expectations for the end of the first quarter. We want the Fed's presence in the long end of the bond market reduced dramatically, as we've written about almost, I'm sure, for many of you ad nauseum. So as far as this week goes, we've got a couple tricky auctions. We've got 10-year tips. Recall a 5-year tips auction had a 7 basis point tail back after the Fed meeting. The environment's tone's a little bit better right now, but nonetheless, can be a tricky auction. We've got the 20-year auction, which is that strange point on the Treasury curve. That one could be tricky as well. We get some more manufacturing data this week, and we'll get more financial earnings from regional banks, the first bit of tech earnings, and industrial sector earnings. We saw Triple M reported this morning, and the reaction was pretty good. Revisions are very mixed. They're going down for tech, they're going down for industrials, they're going up for financials. Again, we had a chart in the weekly showing you revisions. But obviously, there's been a surge in business confidence, and so realizing that will be absolutely crucial. That brings us to sequencing of policy, and it does look like we continue to move towards a single reconciliation bill that will include tax and spending policy that Speaker Johnson would hope to be merging with the Senate bill sometime in March and passing by April. That would be a very good outcome for that business confidence surge and the capital spending outlook. But all that remains to be seen. We're just getting started. So have a good week, everyone. I'll be back in Colorado by the weekend, and we'll talk to you next week.